Hi everyone, welcome to a new video. This is CCalle Mercado. Today we are going to review a company I've been adding lately, and as you've seen in the picture of this video, it is Crocs. So let's get started. First of all, we will watch what the company does. After that, we will study if the acquisition of herein that they've done recently was reasonably priced or if they are overpaying for this company. In third, we will watch the financials of the company. We will study the balance sheet, the income statement, and the cash flow statement. And we will do it also with some ratios. And after that, we will see what the valuation of the company is based on different measures. After that, we will study the risks of this investment and the conclusion, put it in all together. So starting with the company, Crocs is the company that makes these weird shoes called Crocs. Crocs is actually the brand of this, the name of these shoes. But they are also always advertised as being very comfortable. But beyond that, the material of the shoe is called Croslite, of which Crocs has the trade secret. It is an ultralight material, sleep resistant, antimicrobial, insulating, UV resistant, recyclable, and ergonomic. So actually, Crocs goes beyond the comfort of a shoe. It is also very secure, and it is the reason because we also can see this kind of shoe being worn by people in the public health service or in health services. They actually have outsourced the manufacture of their shoes mainly to China and Vietnam, although they are increasing their production in some other countries. And they have a strong marketing strategy to boost the revenues and the sales of these shoes. So beyond what they do, they design, they produce, although the production is outsourced, and they sell and distribute these shoes. The distribution is made not just in third party stores, but also directly to consumers through their website and through some proprietary stores that the company has. Regarding herein acquisition, which has caused a lot of noise in the market, it has taken the share price of Crocs to a level of 7 times price to earnings. I think their noise is not reasonable, because if we watch the numbers of this acquisition, they are paying like $2 billion in cash and about $500 million in shares of Crocs. That is a total amount of $2 billion. I've been watching that in recent earnings call and in the prospect that the company has provided us in their last earnings report. The company expects herein to provide about $700 million in revenue to $750 million in revenue. Also, by the outlook that the company has provided, we can see that margins of herein are higher than margins of Crocs. You can see it in the last earnings calls and also in the outlook that the company has provided. And it may be about 25% or 30% net income over revenue. So doing this estimation, we see that they are paying for this company that is growing about 10 to 20% per year. They are paying about 11 to 14 times earnings of 2022. So for a growing company, I think that this is a very reasonable price. Beyond that, the company is still growing, and they think the management of Crocs thinks that they can increase this revenue, and they expect to make Hey Dude brand $1 billion brand. So there is a lot of growth ahead, and the management of the company expects that this acquisition will be very great for a company. Regarding the financials of Crocs, current financials of the end of 2021, we see that they have grown revenues strongly compared to 2020, and they have also improved margins, and they have decreased selling and general and administrative expenses, considering as a percentage of revenue. So they have some operational leverage, which is fine for a company that is growing, but they have seen interest expenses, how interest expenses are growing. This is because they have taken a lot of debt to finance the repurchase of stocks of the company. This is something that I think is also doing some noise, causing some noise, because for a buyback politic to be good for the company, it should be done at an undervalued price. In the last several months, the price of the company was high. It was trading at high multiple, and they've been doing some buybacks. In my opinion, it wasn't unreasonable, and I think it will provide some growth and some benefits for owners in the future, although it all depends if the risks of the company finally materialize or not. So as you see, the earnings per share are about $11 per share, and the company is today trading at about $80 per share. So it is about 7 times earnings of 2021. We also see in the balance sheet of the company that the company has a strong financial position, although with the acquisition of Hey Dude, they will acquire $2 billion in debt. That should be added here to this balance sheet, and they will also be issuing about 2.8 million shares to pay for that acquisition. So although this is the most recent balance sheet, it could be outdated because of Hey Dude's acquisition. Anyway, this weakens a bit the balance sheet, but they will be generating cash flow in the coming years to put this leverage down consistently. Here in the cash flow statement, we can see how they've been repurchasing stocks of the company. We can see it in investing activities. They have repurchased many stocks that they have financed this by issuing debt. And we also see in the first part of this cash flow statement, we see how they have a huge amount of deferred tax. What does this? We have also seen it in the balance sheet. This means that they've paid in advance taxes that they won't pay later. So this will be a tailwind for the cash generation of the company, and likely for paying down the debt that they are issuing to pay for Hey Dudes. And well, I don't expect that item to be in the cash flow statement in the coming years, as it has been here in 2020 and 2021. It has been because of some sales intercompanies of intellectual property. So as I say, it is a 1 time or 2 times in 10 years item, and I don't expect it to see it in the coming cash flow statements of the company. Moving forward, we have here some ratios. These are sales ratios. As we see, the growth of sales is pretty strong. It has been in average almost 20% per year. Although we see some cyclicality in the company, maybe because it is a fact, it has been in the past, but that is a qualitative assessment. But the company has grown revenue and revenue per share consistently. They have been more or less taking good care of inventory, of debtors, and of creditors. So nothing really to highlight here. After that, we see that they have no dividends. They're retaining all of their net income. Sales and general expenses are decreasing as a percentage of revenue, as we've seen before, and earnings growth before taxes is also very strong. Tax rate has been fluctuating a bit, but it isn't nothing weird. You see here some ratios of assets and balance sheet ratios. You can pause the video if you want to watch any of them more closely, but there's nothing to highlight here as we're thinking. Everything related to equity is going to be distorted in this last year and maybe in 2022 because of the decrease of equity due to the buyback program that the company has been going through this year and 2020. Again, here you can't really compare the return on equity because of what I've just said. But as you see, the return on employed capital is really high. In 2020, it has been of almost 120%. But this was really strong in 2018 and 2019 too. So we see that the company is employing very good the earnings they are retaining. So maybe they have they have been awarded for trust because of what they've been doing. Again, in free cash flow per share, free cash flow growth, it has been a very strong performance. Operating cash flow over operating income is also strong, being about 100% every year, although it fluctuates. Usually, cash flow fluctuates more than earnings because of its nature. So it is perfectly normal. Interest coverage will have a boost. Well, it won't be so good in 2022 because the leverage of the company has increased because of Heydut's acquisition. But again, it is nothing to worry about. It is not too leveraged, and the financials of the company are very strong, actually. So going through the valuation of the company, I have assumed that the free cash flow remains the same in 2022 and 2023 than it has been in 2021. Although if we make it manually, we see that because of deferred tax impact, the free cash flow of the company should be higher than what I'm writing here. So we are being very conservative here, and we are applying a growth of 10% from 2024 to 2028 and 15% from now on. From 20 for that year until 2031. After that, we assume that there is no growth in perpetuity, and the discount rate we are using here is 11%. So it is I would say a big discount rate just because of the risk of the company. That is the financial risk, the leverage that the company is having, and the risk that the company is going through a peak of the fate. But we are putting in all those risks, and with that in mind, the price per share or the target price per share is over $120. So this gives us a margin of safety of over 45%, which is in this market that is huge. I've also done a PE ratio calculation of the intrinsic value of the company. Here you see how I calculate it. You can pause the video if you want. Basically, depending on the growth of the company and the dividend yield, you have an estimate of a P ratio to apply to the company. After that, you do some adjustments based on the business risk, the financial risk, and the earnings visibility of the company. I'm adjusting this earnings visibility because it might be a fate that company is going through. I don't think so, but it could be. And I'm estimating a growth of 10%. So I'm also being conservative here. So I require a margin of safety for a company of this quality of almost 20%. So the pair of what I would be willing to pay would be over 11 times. And the company is trading currently at about 7 times earnings, so it is actually cheap. Here we see how doing this P ratio calculation, the buy price of the company would be at about $157 per share with a margin of safety of 88%. So with both valuations we've done, the free cash flow discount and the P ratio, we see that the company has a huge margin of safety. Of course, this is taking into consideration that we don't think that the company is going through the peak of the fate that they've been through before in 2006, 2007. I think that the company has a sustainable competitive advantage and a strong brand. So this is the margin of safety that I have with these assumptions. Of course, there are risks. The risk number one is leverage. The company is taking a lot of debt to finance the acquisition of HeyDude. So if the company goes through a downturn of their revenue, their earnings, and their free cash flow generation, they might have a problem. After that, we have the fade situation. Maybe this is trendy now and it won't be the next year, but the company has already provided an outlook for the first quarter of 2022, and they think that the sales are growing at about 15 to 20%, and they are adding HeyDude, a growing brand to the portfolio of products that gives some floor to the company, to the price per share. So I think this isn't a risk. It is a risk that we should consider, but we won't go bankrupt because of this. And finally, as any company acquiring another company, you have some issues. You will have some one-time items of going through the acquisition and the integration of both companies, and this might be a risk. And finally, I've put here the dead money risk, that is that the company will stay cheap for a long time. But to overcome this problem, you have the growth of the company and the growth of HeyDude, that even though the multiple don't expand, you will have a growth of organic sales and organic earnings and organic net income. So the minimum amount of return you will have buying to this share and excluding any multiple expansion, it will be the growth of earnings per share, which will be not this year, but from 2021 in advance, you will have about 20%, 10% maybe 10% being conservative. So it won't be really that huge risk. Putting it all together, the stock is really cheap, no matter what valuation you use. If you use a P ratio calculation, a discount free cash flow calculation, the stock is cheap Financials are good, although they are getting more leverage now. They have more debt. Interests are going to be higher. But with the free cash flow generation of the company, they expect to go back to normal in 2023 and start buying back shares of the company again, which in the past has taken the price to almost 35 times price to earnings ratio. That is a huge multiple expansion we might expect about 2023. Again, the acquisition of the company of Heidut and the stop of the buyback policy of the company until the leverage gets down has caused a lot of noise. This is because this is the reason because the opportunity of buying Crocs at this price exists. So I think this is more than a risk. This is a big opportunity for buying the company and to obtain a very good return in the long term. And finally, you have to consider that we can be going through the risk of a fade and a vanishing fade. So you also have to consider that if you buy this company and maybe you have to manage that risk, not giving this company a huge weight in your portfolio, but this is a risk that you can avoid and you can manage. In the stock market, you don't have to avoid risk, but to manage it accordingly. So I think this is a share to have in your portfolio. I personally own it, and here I give you the disclaimer. And so to conclude, I want to thank you for watching this video. I hope that you found that useful, and if you have any comment or want to discuss anything about the valuation or about what I've said about the company, if it is a fade or not, you can leave it in the comments. I will reply you. And again, thank you for watching this video. Hope you have a very nice day.